Hello. In this video, I'll be going through an introduction to post-retirement benefits. What are post-retirement benefits? These are benefits that an employer may pay out to their retired employees that are not pensions. So if you're not familiar with pensions, please go see previous videos because we have many. But these are other types of benefits that an employer may pay, such as dental coverage. When a person retires, they could pay out some life insurance upon their death. They could provide group legal services, and most commonly, it's the medical coverage. So when a person retires, they will get some or all of these benefits. So what is a company supposed to do, a corporation? Because their employees may become entitled to these benefits. And so what they have to do is they have to accrue a liability and also an expense for those future health care costs on the accrual basis. And we'll go through it in a few slides. If you're familiar with pensions, then post-retirement benefits should be fairly easy to understand because a lot of the accounting for it and the concept of it is pretty similar. And the most similar things between pensions and post-retirement benefits is that they're both a form of deferred compensation earned during the employee's service life. So the employee earns it because they've worked for a company, but it's considered to be deferred because they only receive those benefits upon retirement. And both of them have this obligation, or let's call it a liability, that a company has to accrue because they're going to pay out some future amount. And both of those liabilities, whether it's a pension or post-retirement benefit, is we're going to take the present value of the future benefit costs and present value to the end, to current year, and then record that as a liability. So it's really important to differentiate between the post-retirement benefit plan and just regular health care, right? Regular health care benefits are receive them as you're working, you're eligible for them, and the corporation, it's simply a part of their compensation expense. The retiree health care benefits you only receive when you retire. Now, based on your eligibility to receive those benefits is based on age, or it could be the numbers of years of service that you've provided, or it could be a mixture of both, such as, employee X receives health care benefits upon retirement when they are 65 years old and they've worked for the company for 15 years. It could be a mixture of the two. Let's just compare pension versus post-retirement health benefits. So the pension benefits, just so as a quick recap, is when a employee works for a company for a certain number of years and they get pension when they they get a pension when they retire, and that is a guaranteed payment that the company provides each year of retirement, okay? And a pension is usually based on the number of years an employee works for the company. So the longer that an employee works for the company, the greater their pension benefit will be. Whereas a post-retirement health benefits, it says typically unrelated to length of service, meaning that you don't get more health benefits just because you've worked for the company longer. It's if you've worked for a company for a certain number of years, or depending whatever their plan says, once you reach eligibility, you just get those benefits, but they don't grow over the number of years that you have worked. Pension, the amounts are typically predictable, right? Because there are some assumptions in there when we calculate our projected benefit obligation. But once that's we predict that you will get $60,000 per year in retirement for as long as you're alive, right, after retirement, versus post-retirement health benefits. It's really hard to predict what those amounts will be because they can vary from person to person, from retiree to retiree, based on their individual medical needs. And in a pension plan, employers commonly pre-fund the pension obligation. So this means that they have a plan asset. So an employer will have a projected benefit obligation, that's the liability, right, that they project to owe in the future. But they also have this asset, a plan asset, where they contribute money into the asset, and then that money is invested in bonds and real estate and stocks and whatnot, and hopefully it just grows. Whereas for post-retirement health benefits, oftentimes employers do not have a plan asset. They don't pre-fund those healthcare obligations. Also, with post-retirement benefits, oftentimes the retirees themselves will share costs through monthly contributions. So just like if you have a job right now that provides health care, most likely you have to pay a portion of that health care. And so when usually retirees will have a common type of plan where they also have to share in the monthly contribution costs. And then also finally, with much different from pension, is if an employee is granted post-retirement health benefits, it usually, or it may extend to their spouse and eligible dependents, which also increases the cost, but also increases the variation in costs, again, because you're covering many people and depending on the medical needs. So it's really, really difficult for a company to estimate that future cost, right? And we call it the net cost of benefits, but basically what this is how do we calculate, or there's many assumptions made when we calculate the future liability that a company will have for these post-retirement benefits. And so let's look at how we calculate the net cost of benefits. And this is not the accounting for it. This is just like how we think that these benefit costs will come about. We have to estimate the medical costs in each year of retirement, right? That's what they have to do. That's kind of one thing that they have to do. And keep in mind that healthcare, right? Those costs can fluctuate a lot year over year. If you have a job that provides healthcare right now, think of how much more you're probably paying, most likely, today than you did 3 years ago, because healthcare costs just fluctuate so much, and usually it's not to the employee's benefit. And so you take your estimated medical cost. There could be a portion that the retiree will pay, right, their share of cost. And because it's a retiree, they will be eligible for Medicare, and Medicare will reimburse the corporation for some payments. So there's a lot of different things that need to be considered when you estimate the net cost of the benefits. And similar to a pension, there are a lot of assumptions that are needed to be made in order to estimate the post-retirement benefit, right? This is meaning these are the assumptions that need to be made to estimate the liability that we need to record today for our future benefits that we will pay out. There's some sort of discount rate. If the healthcare plan if the employer has a plan that is funded, you have to estimate the expected return on the plan. You have to estimate your employee turnover, what age are they going to retire, how long are they going to live, and what number of beneficiaries are they going to have and their dependents, right? And what are their individual ages? So a lot goes into this, a lot of assumptions go into the calculation. So now let's talk about the actual liability that we need to, this is a liability that we need to record on our corporate books for these future benefits. And there's two different terms that you should know. First one is the expected post-retirement benefit obligation. And this is also called the EPBO. This is when a company takes all of their employees, they look at their entire employee pool and estimates, here's what we think all of these employees, this is when we think that they will retire. This is how long we think that they will be alive for, and this is what we think, they make all those estimates about how much medical costs are going to be incurred by each of those employees and their dependents. And they have a total liability. It's like this huge sum, okay? That's the EPBO. However, when you're talking about post-retirement benefits, and I'm going to focus, I keep saying healthcare benefits, but these are all post-retirement benefits, but the most common one is healthcare, and I think probably the easiest one for us to understand. All those employees are not going to be working, the required number of years in order to vest in those benefits. It's really just as the employees work, then they get 1 year closer to vesting, right? Which means there's 1 more year likely that we will have to pay out those benefits in the future. And so what is recorded on the balance sheet as a liability is what's called the accumulated post-retirement benefit obligation, the APBO. It's really a portion of the expected post-retirement benefit obligation. Let's go into a graph, and I think it's kind of easier to see. Here, this first graph is related to pensions. And in pensions, for every single year, right, if this is the number of years that I work in a company, then I, as an employee, am going to get a higher pension amount upon retirement. So every single year that works, as I work, my pension payout when I retire is going to go up, which means that the employer's liability is going to gradually go up as the number of years increase, right? Now, let's talk about post-retirement. And let's just take the healthcare. So let's just say here I get hired year 1, but this company says you have to work for us for 35 years before you vest into our post-retirement healthcare plan. Okay, so as I work here, I'm not earning anything. I'm not getting, it's not like as I continue working, I will get more healthcare benefits. Because if I quit in here in year 34, then I get 0. But if I make it to year 35, then all of a sudden I vest in my entire healthcare benefits on my post-retirement benefit plan. So think of the expected, I'm going to write it out, the expected post-retirement benefit obligation, right? The liability is here. That's what your EPBO is, your EPBO. So it's right here. It's this top amount. This is what we expect when all of our employees retire and invest into this plan. This is the cost that we think that these are the benefits that we think that we will have to pay out. And the EPBO is present valued, okay, to like whatever you're calculating. Let's just say you're calculating 2025, so it's present value to 2025. Okay, so this is the total obligation we expect to pay if all these employees get to this 35-year mark. The APBO, the accumulated post-retirement benefit obligation, is a portion of the EPBO. And that says, as I work every single year, okay, for my company, now I'm getting one step closer to vesting into my healthcare retirement. So the likelihood of that happening is think of it as like it gets more and more likely that we will have those benefits paid out because I'm getting closer and closer to that 35-year mark. So then we accrue the APBO based on the number of years of service that I've put in, okay? And the APBO is a portion of the EPBO. This is what goes on the balance sheet. Let's take an example. The net cost of providing healthcare benefits to Callie Farrow during retirement has a present value of $10,842 as of the end of 2025. If the benefits and therefore the cost relate to an estimated 35 years of service and 10 of those years have been completed, the APBO would be what? So in this problem, the 10,842, that is the EPBO. It is the expected post-retirement benefit obligation, right? This is how much we expect to pay in total for this one person, right? This one employee, as of the end, when we present value all the costs as of the end of 2025. But they've only completed 10 years of service and we need 35 for them to vest into it. So how do we calculate our APBO, our accumulated post-retirement benefit obligation? We're going to take our EPBO, the 10,842, and multiply by the number of years of service complete divided by how many years it would take to actually vest in total into this healthcare plan. So 10 divided by 35. And so our accrual APBO is $3,098. That's what we would put on our balance sheet. Let's continue and say that it's a year later. So if the assumed discount rate is 6%, a year later, the EPBO will have grown to $11,493 simply because a year's interest accruing at that rate. Okay, so our EPBO doesn't really change, but for the fact that we have to accrue more because it's a year later at 6%. The APBO, however, is a portion of the EPBO related to service up to a particular date. Consequently, the APBO will have increased both because of interest and the service fraction will be higher. So our new EPBO, okay, is going to be the beginning balance of the EPBO times however much it's grown by the interest rate, right? So we get 11,493. And now, again, this is a year later. So I, as the employee, I'm 1 year further in, or right, to vesting into this healthcare plan. So out of the 35 total years required, so I'm going to take my EPBO times 11 divided by 35, and so my year-end APBO, accumulated post-benefit obligation, post-retirement benefit obligation, is $3,612. So let's just roll forward the accumulated post-retirement benefit obligation, right? This is what goes on your balance sheet. I had my beginning of the year of $3,098. Then I have to accrue interest on it, okay? And just like pensions, when you do your your projected benefit obligation, you take your beginning projected benefit obligation multiplied by the interest rate that you're giving, and that will be your interest cost for the year because this is a long-term liability on our balance sheet. And so that will increase the liability. And in our case, it's $186. And there's a service cost component, just like we have with pensions. And that is now I am 1 year closer to vesting into this plan, right, into this healthcare plan. So I take my EPBO multiplied by 1/35th, right, because in this example, it's just that it takes 35 years to vest into this healthcare plan, right? That's when you're eligible for those healthcare retirement benefits. And so that will give me $328, and that'll give me my ending accumulated post-benefit obligation of $3,612, which is what gets recorded on the balance sheet.